Hey, good morning. Welcome. It is Tuesday, May 28th, half an hour before the market's going to open. We had a holiday yesterday, so that means we're probably going to look at a low volume session today as we wait for market participants to come back into work. So the S&P 500 on Friday was very low. Actually, all the last 2 weeks it's been really low. So this move higher and this chop sideways was all associated with low volume. And in fact, it wasn't just low volume, it was decreasing volume, which is the exact opposite of our price movement right there. So we have divergence between price and volume. And normally that's not a very good sign. If we're moving upwards with less and less volume, that's sort of like saying we're running on fumes. And yes, we can move up a little bit, but eventually those fumes are going to run out, and either we need volume to come back up, or we need to add gas back into our car, or this is going to start dying off. That doesn't mean that it's going to change trend. It just means that it can't really move higher, which we kind of saw over here where we started to go flat. So we could chop sideways instead of moving downward, but most likely, based on everything else that we saw and I did on the Friday review, we're most likely going to pull back at least a little bit. So today, we're not going to expect too much activity. There might be a little bit of volatility, but overall, it's probably going to be another sideways day with low volume. If we look at our futures were up a tiny bit on the S&P, about 15 basis points. We've got the NASDAQ at about 20 to 25 basis points. And we've got the Dow at minus almost not quite 10, maybe 5 to 7 basis points. So all random, but it's discouraging to see this divergence in the NASDAQ and Dow continue. We saw that pretty much all last week. And for it to continue into this week, that just tells me that the market is weakening. We are being held up mostly by tech. And we saw that when we looked at these sectors previously on Friday. When we look at our sectors, we see that the only ones that are really up are SMH. Home builders have sold off, lower high. I'm not going to count any of the metals. Tech went higher. QQQ because of tech and SMH. And XLC really, it just kind of curved and flattened out. It didn't quite hit these all-time highs over here. So we can see that QQQ, and by the same token, the S&P 500 have really just been carried upwards by XLK, SMH. That was helped a lot by the NVIDIA earnings that we had last week with this jump upwards and the continuation on Friday. We'll see if that can, well, it looks so far pre-market, looks like it's continuing. So really this entire market is being held up by a single sector and a small handful of stocks within that sector. Why do I say that? Because when we looked on Friday at our momentum, we see that in the S&P 500, only 50% of the stocks, only 250 out of those 500 are above their 50-day moving average. But look how high above the 50-day moving average we are. That means a small handful of stocks is carrying this upwards. And we can already see that in the tech and semiconductor sectors. So that's not really encouraging. Normally that'd be fine. That'd be normal for tech to lead. But for tech to be the only one that is up and every single other sector is pulling back, that is a sign of general weakness in the market. So most likely we are going to pull back at least some, maybe to the EMA 20, maybe back to the MA 50, and then we'll see from there. If this market is really weak, then we'll come back and test this purple line right here. And if we're super weak, then we'll finally get a 10 to 15% correction, which we've been anticipating for a while, but so far that hasn't really manifested itself yet. So for now, we're just going to be cautious. We're going to stay neutral or slightly bearish until we see things develop. That's probably not going to be today because of the low volume that we're expecting. We could be wrong. It could be, this year could be the year that defies the historical pattern, but most likely, when things are repeatable, they become predictable. And most likely, we're just going to have a low volume day today. So let's take a look at our economic news. We'll see if we have a possibility of volume coming back into the market, and with that volume, a possible direction, either down or up. So our economic news for this week, nothing yesterday, obviously. Today, consumer confidence, that'll be important. So that's coming after the market opens. So definitely coming off of a holiday weekend, we definitely want to wait and see what the market does. And we definitely want to wait until at least 7 o'clock to see how this market reacts to that consumer confidence report. That's really the only significant thing happening today. Tomorrow doesn't look like anything super significant. GDP on Thursday. So consumer confidence definitely has the ability to give us some movement and directionality. Given that we're expecting lower than normal volume, this could cause a run or a gap, or it could just mean that we're super muted. It's probably not going to be one extreme or the other. It's not going to be something in between, most likely. Thursday, this GDP report, when we have full participation in the market, basically everyone's back from vacation, then we could really see volumes pick up and a strong movement with momentum, depending on how that GDP report comes out. That one comes before the market, pre-market, so we'll get to see a preview of how that is going to affect us during the open and give us a possible idea of directional movement that might come from this GDP report. Other than that, we've been following the bonds. Bonds have been surprisingly strong, but you can see that we're opening a little bit lower today. But this is developing into a horizontal support, which, if it holds, that'd be in defiance of the odds and probabilities of a rate cut in July. At some point, we're going to snap back into reality, and then we're going to break this horizontal report and then continue to move downwards. So we've seen this Fed watch several times, but we might as well update ourselves and see if anything has changed this morning. But based on the price movement, yeah, maybe a tiny bit, but I wouldn't expect miracles here. So over here, okay, well, it's interesting that we're actually giving some probability to a rate hike now. That's encouraging. And then we only have 10% at the rate cut. So this should have been a stronger association with a movement downward. So we'll see. We'll see if we get that in the market today and we break below this horizontal support that we're seeing. All right, let's take a look at our volatility. Our volatility has been super low, so we're going to expect that to tick up a little bit, and we are up a little this morning. So maybe we'll continue to move upwards and get back into this normal range where we've been all year, because we're still below that normal range. So we're going to expect volatility to come back up, not necessarily spike way up, although eventually, of course, we are mean reverting. So we do expect a spike at some point. Right now is probably a little too early since we just came down, but we should slowly move upwards, and then the possibility of a spike later on, maybe in, looks like late June, mid to late June. So for now, maybe a slow rise. That could be what associated with a small pullback into the EMA 20 or MA 50. That could just be what we're looking for right there. If you look at CPC, CPC is currently at completely neutral at 1.00. So that's not giving us much information right there. And let's just take a look at what is looking good in the market. For the weekend, I was doing my research, and actually metals, gold is looking pretty good. I know this to a lot of people looks like a double top and will get rejected. But what we're seeing here is that at least so far, where we've paused right here is a higher low. And technically this high right here was slightly above that one. So just barely a higher high, even if we give it, if we consider it a horizontal. Okay, even if we consider that a horizontal, we would be looking at an ascending triangle. What is it? Make it the same color and thickness. Okay, so ascending triangle. So that's encouraging for gold, but even more impressive than gold is actually gold miners. So this is on a clear uptrend, a clear higher high, a very clear higher low, pull back into the EMA 20, and this looks like it could easily back. Well, look, pre-market it's already up. So I'm a little late to the party, but we could continue to move upwards. That's not unheard of. We'll probably make a new high on this wave up. So GDX, even though we didn't miss, or we missed this EMA 20 level, it's still an okay level to go in this morning. And of course, there are other stocks that are, this is an index or an ETF. So we may be able to find something even better. So I was looking at AU looking very similar and look like, so this morning looks like it's popping up as well. AEM, these are all miners. This is a beautiful uptrend. This is the best one out of the three charts I've seen so far, although GDX looks very similar to this. AEM is looking really good. Wheaton Precious Metals, same thing, a very beautiful uptrend. So to see so many stocks within the same sector exhibiting the same pattern, this is reinforcing that GDX or gold miners are looking very, very good. So I like Wheaton Precious Metals, AEM. So far, those two look the best out of the individual stocks. Royal Gold as well doesn't look quite as good as WPM and AEM. I thought there was one more that I was looking at, but no, I can't remember it at the moment. But I would definitely be interested in WPM or AEM at these levels right here. So I might as well track and just put in a basic long call. Let's just say, let's do, I think Wheaton Precious Metals is probably better followed. AEM average volume 2.2 million. Average volume 1.4 million. Okay, maybe I'm wrong. Oops, that's not what I want. Option prices. Let's just check out their option volume. Go out to July. A little bit of time. Okay, so good open interest over here. And nice and tight bid-ask spreads on WPM. And then if we look at AEM, also $5 increments, also nice and tight, also good open interest. So I'm indifferent. It looks like the AEM options are slightly more expensive. So do you want to invest $450 or $200, or do you want to invest $300 $25 or $100 something. So I'll just go with a cheaper option just because. Not that that's a good way to to decide, but that's the really I'm indifferent. Like they both look great. So let's just do the wheat and precious metals ones and do a basic long call on WPM out to July at the money for slightly. Let's just do at the money at 330. Okay, well, yeah, the mid, okay, no problem. So we'll save that and we'll track it. This is a pre-market selection. And of course, it does look like when we open, it would be a little bit higher. So if you can't get it at exactly 3.3, maybe you can get it at 3.4, 3.45. Maybe I wouldn't go much higher than 3.5. That could, we're looking at the wrong one. But that could be I would accept that as an entry level personally as well. Okay, so the fact that GDX and gold miners, gold are looking so good, the fact that the QQQ is, or the tech sectors and semiconductors are the only sectors that are looking really strong and look like they're propping up the entire market. Well, that is going to make me very cautious about going long anything else. And in fact, I'd probably be looking at, if I was neutral or slightly bearish in my current portfolio, I would be looking at short to add to get just slightly more short in overall, or slightly more bearish overall inside the portfolio. I'll just real quickly, since we have a couple more minutes, let's take a look at what might be the weakest sector. Home builders not doing well. Retail not looking good at all. So probably, just to be a little bit more basic, materials not doing well. Just to be a little bit more broad than just retail, probably consumer discretionary. Healthcare not doing well as either. Staples so far holding up. Okay, yeah. XLY definitely does not look good. XLRE does not look good at all. So since retail is looking pretty weak as well, I would, out of these two sectors, I would go with XLY. So you can start looking for potential shorts or weak stocks within the consumer discretionary sector and consider those for shorts in your portfolio to bring it slightly bearish. So don't expect to have a super exciting session, although that consumer confidence could introduce some volatility and could introduce some directionality, but probably we're not going to get any real action until Thursday when that GDP report comes out. So I'll end it here, leave you guys to prepare for the opening bell, and I will see you in the aftermarket. Have a wonderful day, everyone.